Hello, Jim here. Today I want to talk about a new way to look at retirement. When you sell options and make really good monthly income and then pair it with your retirement, you can retire earlier than you ever thought possible with a lot more income, plus build wealth a lot quicker. I'm calling this the retirement flywheel or the options retirement flywheel. I'll go into a little bit of detail and share with you what the potential is when you combine options income with Social Security and then potentially even the 4% rule. It can have a dramatic impact. So stay tuned. I think it's going to be well worth your while. Now, how did I come up with this idea, what I'm calling the options retirement flywheel? Well, it was watching different members trading within my membership in the Discord. Some members are doing better than I am, especially with small accounts. And I've kind of noticed this with my own account. I have an account that's a Roth, and it has around 65 to 70,000 in it, and I've been able to grow it a lot quicker. And I've noticed that with a number of other members who have also been able to do that, in some cases with much higher returns than what I'm getting. So the fact that you can grow a small account, and especially if it's a Roth account, it just opens up a world of opportunity. And especially if you're bringing in a lot of income on a monthly basis, meaning you're selling covered calls, cash secured puts, vertical put credit spreads, or even iron condors within that account, different types of strategies, what I call safe strategies. The amount of income can have a dramatic impact. And I've also noticed that as you grow these accounts, meaning a $60,000 account, it's easier to get a higher return on a monthly basis in that size of an account versus a $100,000 account or a $250,000 account. It seems to me, and what I've noticed with trading my own accounts, I have 4 different accounts that I trade. The larger the account, the more difficult it is to make a really good monthly return in that account. It could also be because, you're in the bigger accounts, you may have a lot more investments. At least that's the case for me. So it's more invested. In my smaller accounts, I tend to keep a little bit more cash, especially in my Roth that I'm doing a lot of options trading. So, that kind of leads into how you could potentially run this flywheel. So using a small account, you could potentially double it in half the time as a larger account. Just to give you an example, if you can get a 10% return, and if you've ever heard of the rule of 72, you just divide 72 by the return that you expect to get. So if you get a 10% return, you're doubling the account in 7.2 years. Now, if you can double that, meaning you're getting between 1.5% and 2% on a monthly basis, you're potentially doubling that account every 2 to 3 years or 3 to 4 years. And if you can get 3 to 4% on a monthly basis, you're doubling the account almost every other year, which can have a dramatic impact. I mean, you can kind of do your own numbers. If you have a $50,000 account, that becomes 100, 100 becomes 200, and so on and so on. But as you grow the account, again, it becomes more difficult to make the higher returns. So it's a lot easier to get from 50 to 100 or maybe 100 to 200. But once you get to 200, it does become a bit more difficult. Part of that, I believe, is also because of already being pretty well invested in those accounts, meaning, you've already got a lot of securities. Maybe you have a lot of dividend paying stocks, kind of like myself. So you don't have as much cash to just be doing options to earn options income. So what ends up happening is as that account grows, you do end up with a smaller return on a monthly basis in a larger account. So a $250,000 account, you might be able to average 1.5%, maybe 2% versus a $50,000 account. You might, if you have a really good month, you might have a 6 or 7% return in one particular month. So, and that's what kind of leads to this, what I'm calling the retirement flywheel, the fact that you can double these accounts pretty quickly. And then, having them in a Roth, you really have a lot of flexibility with pulling the income out, especially after you hit 59 and a half. And then what happens is you can have Social Security. Look at Social Security as just one additional income stream. So depending on when you pull it, I plan to to take Social Security at 67. Now, if I have health issues, I'll probably take it sooner. But if I'm healthy in 2 years, I'll be 60 later this year. I probably won't take it, but maybe something happens in 60, when I'm 63. And so maybe I'll take it at 63. But my plans currently are at 67. So that's how I'm looking at planning for my Social Security, determining how much I'll get, and then how it impacts this flywheel, how it also kind of jumps in and provides income at a specific age range. And then I also like the 4% rule, especially in the later years. Maybe you've started Social Security and you don't need as much income. You could turn on what I'm calling the 4% wheel, not wheel, but the 4% rule, and have some cash flow related to that, just pulling a little bit out of your account. Of course, the whole time you also will have your options selling, meaning the income you're bringing in from selling options will also have an impact. At the end of this video, I'll go into more detail. I'll share with you what it looks like. I actually use ChatGPT, to kind of organize it so it's really easy to follow and get an understanding of where I'm going. So the question to you, if you're watching this, is this something that can really happen? Is it a reality? In my title or my thumbnail, you can see in the number crunching I did using ChatGPT, it showed that I could turn potentially a $68,000 account into a 1.7 million. And that's assuming I was 50 years old. I'm, of course, nearly 60. But if you're starting this at 50, and you're doubling your account a lot quicker than you would have with just, the standard 6 or 7% return, it can actually work out, and it can work out really well. So let's jump into the details. I don't want to talk too much in the beginning of the video. It's a little bit easier to understand it when you have a true visual. So let's jump into the next section. Now, before I jump in and share with you the flywheel strategy in detail, I set up this spreadsheet kind of working my way towards this strategy. Originally, I was going to just share this spreadsheet, but then when I started playing around with it and did some stuff in ChatGPT, it kind of took me down this different avenue. But what I've done here, this is my Roth monthly income. These are actual numbers from my Roth account over at Fidelity. I just pulled out how much I made each month. So in January, and I pulled it directly out of my documents, my planning worksheet. So in January, I did 923. At the time, the account was worth 60,000. So it was like a 1.62% on a monthly basis. The next month, I did a little bit less, 870. And at that time, it was like a 1.38% on a monthly basis. March, I did a little bit less. And part of this is we were heading into April. The market was kind of going through a rough time. But I was also not trading enough in my Roth account. I was ending up doing a lot more trading in my IRA, which was a mistake. You'll see that in a moment. So in March, I did 783, 1.28% on a monthly basis. And then in April, we went through the rough time in April with Liberty Day. I think that was the Trump tariff Liberty Day. And I had a lot of things get assigned. And that's when I realized I wasn't doing enough in my Roth account. I was doing way too much in my IRA. At that time, the balance also decreased to 58. And I only did 0.88% on a monthly basis. So 524 divided by 58,000, that comes up to 80.88. But then in May, for the next month, I decided to do more trades in my Roth and then to do fewer in my IRA. So suddenly, I ended up bringing in a lot more income starting in May. So the first month was probably my best. I brought in nearly 5%, 4.71%, so 28.38 on a balance of right around 60,000. Then in June, not quite as good a month, but still a really good month, 1662, which was almost like a 2.9%. And then in July, very similar. I almost had the exact same amount, 1884, which is actually this must be 2.6. And then the next month was 2.74. Actually, this is 2.9. The balance went up quite a bit. in July. So you can see pretty steady monthly income and this is just premiums for selling options. This balance here does represent how much the account grew. So it is the total value, and that includes all the different assets that are in this Roth account. So the totals, I brought in a total of 9,684. The average was 1,383. The 62,431 is the average of what my balances were. I don't know that that's as helpful, but then I'm using it to kind of get a basis of 2.2% on a monthly basis. That's what I was earning. Some months, like we see up here, was 4.71, but in general, 2.2%. So on an annualized basis, that would be almost 25%. Now, it would be even more if I just based it on these, because now as I go forward, I'm doing a lot more trades within my Roth, which I should have been doing from day one. It was kind of stupid not to be doing more, because again, with the Roth being, the best vehicle for retirement, I should have been doing more from day one. But you kind of live and learn. And then down here, I'm just talk about the beginning, the ending, and this is what the return looked like at the end of July. And it was for year to date 13.11. At the same time, the S&P 500 was 7.78, and the Nasdaq was 9.04. I think at certain times, like if I look at it on a yearly basis, it was like 22, 23%. And then what did I learn? Be sure to balance out your put positions between multiple accounts. I ended up doing way too many in my IRA. I should have done more in my Roth, as well as I should have done more in my different Schwab accounts. I have two taxable accounts within Schwab. I have my brokerage one and my brokerage two, which now I'm also doing more trades, especially wheel-based trades. So this kind of starts out the hypothesis, can I earn 2.2%? Well, I've been able to do it. And like I said before, I've had members who, I believe one member had 13% in 1 month. I'm not a risk taker. This individual is definitely more of a risk taker, more willing to use the leveraged funds and riskier types of trades. I'm kind of set in my ways, but I am watching what they're doing, and I might make some changes down the road, but I'm happy with my returns. So this kind of gives me the basis. I can also, see, well, I can potentially use a bit of a higher return. So instead of the 2.2%, if I average these out and divide them by 4, I think it's like 3.44%. And that's what I'll use in the next part of the video when I talk about this flywheel strategy, the option flywheel strategy. So hold on, let's jump into the next section. Okay, now here's my flywheel strategy, my option flywheel strategy. I used ChatGPT to come up with this. So the strategy shows how selling options inside a Roth IRA can generate monthly income and long-term tax-free growth, even funding retirement. So checkpoint 1 is what I call the growth phase. So if you're a 50-year-old, it would be from 50 to 59. The starting balance in this case, and I was using my own account. So what potentially could happen from here on out using this strategy. So starting with just shy of 69,000, 68,847, and then a stepped return schedule. So this relates to what I was talking about before. You can potentially make higher returns while the accounts are smaller. As they potentially grow and become bigger and bigger, it becomes a lot more difficult to get the kind of returns in a small account. At least that's how it's worked for me. So year 1 through 3, it's like a 30%. So like 2.5% on a monthly basis. But then when you get to year 4 through 6, the account will be a lot bigger, and it's more like 20% on a yearly basis. So that might be closer to 1.5, maybe 1.6% on a monthly basis. And this pretty much jibes with what I've been able to see with my different accounts and all my accounts overall, with how much premium, and this is premium from selling options, that I've been able to make pretty much on a monthly basis. And then years 7 through 9, it'd be more like 15% or potentially even a little bit less than that. But for coming up with a strategy, it's more, in my mind, it's more like 15. No withdrawals since it's in a Roth, and no additional contributions. It's all just the 68,847 that you started with. The ending balance at age 59, and again, this is using ChatGPT to come up with the amount. So 1 through 3, you were using, like if you used Rule 72, you get a 30% return. Years 4 through 6, a 20, and then years 7 through 9, so 68,847, and that's also, as you're going, bringing in that income every month, you would end up at age 59 to have 345,666. In this phase, leverages compound growth while the account is small and easy to scale with options. So, and then checkpoint 2 would be age 60 to 74. I could have also said 59 and a half. I turned 59 and a half a couple months ago, so I can access my different accounts. I don't plan to, but this next period is from 60 to 74. So this is where it ties in Social Security and then potentially even the 4% rule. So the starting balance, just like from up top, is 345,666. The annual options return, I'm sticking with the 15% versus the higher. And then the strategy is 7.5% of the balance used for income. So instead of reinvesting everything, I'm using 7.5% for living expenses. And then the other half I'm putting back into the account so I can continue to grow it. And then Social Security, like I said before, I would start it at age 67. This is a rough estimate. 2,300 a month is about what I would get. I think it'd be a little bit higher. These numbers are, I believe, a year old. It might be closer to 2,500 or 27,600 a year. And then the annual income at age 70 would be just from the options premium income, 78,000, Social Security, 27,600. So I'd be making 105,600, which is, if you watched any of my previous videos, that's well more than enough to live off of. One thing I do try to tell retirees is, you're going to end up leaving a lot of money to your children, but enjoy yourself while you can, especially do fun things, do active things when you're younger. My dad's 85. He's really slowed down. He was a lot more active in his 70s. And, you definitely slow down the older you get. So do a lot, travel, get out there, play tennis, play golf, spend time with the grandchildren, do those things that are really meaningful, because again, once you get into that late 70s, early 80s, it has a major impact. So the ending balance, if you continue to put half in and you're still growing the account, would be 1,176,203. This phase maintains growth while beginning to shift the account into income producing mode. Checkpoint 3 adds the 4% rule and continues the Social Security phase from 75 to 84. And it could continue well past 84, but I'm using 84 kind of as a basis. And your account would continue to grow. So goal, stop trading, let the account grow at 8%. So at this point, it's 75. I have a lot of members who are 75 and older. So this is one thing a lot of people would disagree with. You might still be trading at 75. Like I said, I have some people in their late 70s and even early 80s that are trading and doing quite well. But in this case, you would not be continuing to trade. You'd be using the 4% rule. So you stop trading, let the account grow at 8% annually. So a little bit of a smaller return, of course, because you're not trading. You're not getting that options income or the options premium on a monthly basis. And then follow the 4% rule for sustainable withdrawals. So the missed income can be partially replaced by using the true 4% rule. So taking around 4% out of your account to help you with living. So with this, the balance again would be 1,176,000. You could do a growth rate of 8% annually. Withdrawal rate is 4% of balance of each year. And then Social Security continues at 27,600. A lot of you probably would have more Social Security. I'm not married, I'm divorced. So I don't have a spouse's income like that. So annual income is 47,048. Social Security 27,600, and then the total is 74,648. So it is a lot less than the checkpoint 2. But another thing that's pretty important to understand is as you do get older and you can't travel and you hit your late 70s, early 80s, you don't spend as much. You end up eating at home a lot more. There's exceptions to the rule, but in a lot of cases, it shows that people spend a lot less in their late years compared to when they're younger. In your 60s and early 70s, you probably continue to travel and do all those things. But once you get into your 80s, you really slow down. The final phase prioritizes long-term security, letting your Roth continue growing even while it provides income. So summary of checkpoints. So checkpoint 1, you go from 68,000 to 345. Checkpoint 2, 345 to 1.17. At that point, you're age 60 to 74 with partial income use. And then checkpoint 3, you go from 1.17 million to 1.77 million while withdrawing and collecting Social Security. Now, you could do checkpoint 3 and take a lot more to live off of because again, you don't necessarily need to leave so much money to your children, but I know most of us want to. Why this works in a Roth IRA, tax-free growth and income. After age 59 and a half, option selling provides scalable monthly income. Partial reinvestment during retirement keeps the account growing. Social Security reduces withdrawal pressure. And then the 4% rule protects principal while funding retirement well into your 80s. Now, I trade in my Roth, I trade in my IRA. I'm able to do pretty much any kind of trade. There are limitations since you can't add more funds in there, but I'm able to sell cash secured puts, covered calls, spreads, iron condors. And my favorite trade is the vertical credit spread. I've done previous videos on it, and I'd probably have half a dozen trades in there currently with that. So here's what it looks like. It's kind of interesting. The Roth account value at key points. So you can see it growing from 354 to 1.1 to 1.77. Now, the beauty of this is I did this all on ChatGPT. It made all these graphs for me. And then if I changed the percents, like I did higher percents initially and it looked crazy, and then I went with lower, but you could literally tell it, to change these 3 factors, the growth factors at the top, and it will readjust all of this for you. You might say, well, do it for 15, 20, and 25, or 25, 15, and 10. And it'll readjust all these numbers. ChatGPT, that's partly why a lot of analysts are going to lose their jobs because, you can do so much in such a short period of time. This is just representing what it looks like. And in this other graph, this is what it looks like visually. So the blue is the options income. And you can see you could continue selling options all the way into a later age. Social Security is the orange. And then this is the Roth withdrawals related to the 4% rule, where part of it is still going in. You're still pulling out 4%, but the account's growing by 8%. So you can kind of get a feel for it, and you can see this is where it reaches 1.17 million. So the blue bar is options income, 60 to 74. Green bars, Roth 4% withdrawals, 75 to 84. And then orange bar, Social Security starting at 67. I really like how ChatGPT does this. So And this is what I've seen. I've been able to, within my Roth, as I showed you earlier in this spreadsheet, I've been able to update or vastly increase how much I'm making. And actually, with my membership and watching some of the other people trade and the kind of returns they're getting and some of the goals they're setting, it's kind of woken me up to the fact that you can do this kind of a flywheel and you can kind of change how retirement would look. Let me know what you think. Is this something you found helpful, or is it something you've considered too when you start looking at Social Security options, income, as well as pulling money out, like your 4% rule? Is this a similar way to what you're doing? Have you seen similar numbers? Is there something I'm missing or something I've overlooked that could have a big impact? One might be healthcare in the initial stage, this 60 to 74. We still have 5 years of healthcare that has to be factored in, but I kind of factor that in the expense side of things. So this is what I'm looking at. This is how I'm planning my retirement. Let me know what you think. Leave a comment. I typically will respond to the comments within probably 48 hours. So, and as always, thanks for taking the time to watch, and I hope you have a wonderful day.